Hello and welcome to Value Research Helpline. I'm Ruchiran, our experts here at Value Research, and are all set to answer your queries on investing and personal finance. Joining us is Ashutosh Gupta, who heads the mutual fund research team at Value Research and works closely on developing new services and initiatives at Value Research. Welcome, Ashutosh.
Thank you, Ruchira.
Today's first question has been sent in by R. Vishalam, who wants to know whether investment in a pharma fund will fetch good profits.
Well, I'll suggest him to avoid investing in pharma funds and rather continue to invest in the more mainstream diversified equity funds. And this is not just for pharma funds, but for any sector fund for that matter. Because typically, if you see a lot of retail investors start taking note of any sector fund after it has run up substantially. So it's the tendency to chase the momentum that drives investors towards a particular sector fund, which eventually can lead to disappointment in many cases. So for instance, if we take the case of pharma funds itself, now look at some of these graphics that we'll put up. Pharma funds have delivered tremendous returns in year 2020. As a sector, it was up around 60% or more than that to be among the top performers of 2020. Now, if we really break down the performance of pharma sector into 4 calendar quarters of the year, you would notice that a bulk of those returns were delivered by pharmaceutical companies in the second quarter of the year. That's the quarter ending June. Now, as per our estimates, our calculations suggest that the bulk of money came into pharma funds in the third quarter of 2020. That's the quarter ending September 2020. So, while the pharma funds delivered returns, but a lot of investors did not make all those returns because they ended up investing after a bulk of that momentum had passed. And in fact, in the last quarter of 2020, pharma stocks happened to be the bottom performers as many other sectors outperformed them by a fair margin. So the point is that this further reinforces the futility of trying to chase the momentum because, as I said, a lot of investors take note of a sector after it has already run up substantially. And typically, every now and then, every other time, there would be one or the other sector which would appear as the top performer. But it is very difficult to time your entry and exit into a particular sector with precision to be able to benefit from these momentums that happen in different sectors at different points in time. Now, this is one side of the story. Now, look at the graph that we are going to put on your screen, where I would try and walk you through the other side of this picture. So look at the diversified equity funds and the trends in their exposure to pharma as a sector. So you would notice that through the 2020, the exposure to pharma as a sector in diversified equity funds increased from about 5% at the start to about 9% over the year. Not only that, because of this, pharma as a sector, its ranking among the sectoral holdings of these funds increased from 6th ranked sector to be among the top 3. And if you notice, this rise in allocation among diversified equity funds happened fairly early in the year, so that these funds and their investors would have been able to benefit from the rise in the stocks of this sector. So this further reinforces the fact that with diversified equity funds, you would have got adequate exposure to pharma as a sector in 2020, and therefore there was really no need for a separate allocation. You did not need to carve out a separate allocation by investing in funds that focus on the pharma sector only. So by and large, I'd say that for a vast majority of retail investors, sector funds are avoidable and they should continue to focus on diversified equity funds.
All right, so avoid the temptation to invest in sectoral funds and opt for diversified equity funds instead. Now, Hemant Kumar Verma says there has been about 35% appreciation in his portfolio, and though he had invested with a long-term view and doesn't really need the funds right now, he's getting tempted to book profits. So he's asked for your advice, Ashutosh.
Well, given that he has a long-term horizon and he doesn't need this money anytime in the near future, I would advise him against booking profits, because if he does that, then he would land up with an even bigger dilemma of when to reinvest and when to re-enter the markets. When is the right time to invest that money back? However, what I would suggest him is to maybe follow an asset allocation, which he thinks is suitable for him. If the possibility of a market fall from here on worries him a lot, and he's worried about the profits that he's already accumulated in his investments, then perhaps he can follow an asset allocation, something like a 70% equity and a 30% debt. Now, what it does is it provides him a natural and an objective way of booking profits periodically, because once he sets up a 70-30 allocation, and that's just an example, maybe he can choose a slightly different asset allocation for himself, which is predominantly in equity. So let's say he follows a 70-30 allocation, and he rebalances periodically as and when this asset allocation goes out of whack by about 5% or thereabout. Then naturally he would be booking profits in equity whenever equity markets run up substantially, and reinvesting that money in safer debt instruments. So this way he would be able to objectively book profits periodically, and it will take away the stress of taking a call on the markets every now and then. And also, having an asset allocation with some portion in fixed income provides a downside cushion. So whenever the markets fall, because there is some component of his money always invested in fixed income, it would also provide some downside protection. So that's an approach which I would suggest to him.
Okay, so Hemant, stay invested if you don't really need that money in the near future. Now, Dilip Ramdas Sonar wants to know if it's the right time to invest in mid and small cap equities for the next 3 to 5 years.
Well, no, I would advise him against opting for mid and small cap funds given his time horizon, because 3 to 5 years is a really short time horizon to be looking at a risky and a very volatile category like a mid cap fund or a small cap fund. In fact, more broadly, I would not recommend to him an all equity allocation at all for his time horizon. He should have only a limited portion of his money in equity, with the remaining in some fixed income alternatives. So probably hybrid funds would be better suited to him, and mid and small cap funds are avoidable.
The next question has been sent in by Jayant Nagesh Banavalekar, and he asks, which investment is better in present scenario, shares or mutual funds?
By mutual funds, I presume he's talking about equity mutual funds, because there are also fixed income mutual funds, but which are grossly different. So talking about direct stock investing versus investing through mutual funds, well, I'd say that the present scenario has nothing to do with this decision, because ultimately the underlying investments or the underlying holdings in either of these two approaches would still be equity stocks. The only difference is, in case of direct stock investing, it is the investor who himself decides which stocks to invest the money in, how much, and when to make that investment. While in case of a mutual fund, an investor gives his money to a fund manager to take all these decisions on his behalf. So the underlying investment still remains in equity stocks. So the right question to look at is, who should be investing in direct stocks versus who should be considering investing in equity mutual funds. Now, we believe that direct stock investing is for those who can dedicate a certain time commitment, because direct stock investing is a much more hands-on way of investing. So it requires a higher degree of effort and time commitment. Also, the investor needs to have a certain degree of interest and inclination to know about businesses, to understand how businesses are run, and what would make them keep growing in times to come. Also, an investor needs to be able to withstand deep corrections in his or her stock holdings, which may happen every now and then. And finally, one also needs a reasonable amount of money to be invested to be able to build a reasonably diversified portfolio of at least 12 to 15 stocks. Because otherwise, if an investor only holds 3 to 4 stocks, that could be far too concentrated. On the contrary, with a mutual fund, one can get a well diversified portfolio of stocks even with a small investment of say 5,000 per month. So broadly, I'd say these are the kind of considerations one should keep in mind. We generally believe that equity investing requires a certain degree of skill, a certain degree of experience, and a certain degree of time commitment, and a good temperament, which we believe comes with experience as well. So these are the considerations. And for that, we believe that for a vast majority of retail investors, mutual funds tend to be a preferable route.
Okay, so Jayanta Ashutosh says only if you have the required skill set, time commitment, and understanding of businesses should you go ahead with direct stock investing. Otherwise, it's better to stick to investing in mutual funds. Now, Sabu Jose has invested 1 crore rupees in 4 short duration funds for his retirement. And he wants to know if he should continue with them or reduce the number of funds to 2.
No, I think he should continue to remain invested in 4 short duration funds because a certain degree of diversification is highly desirable. In fact, as the events of the last 2 years have revealed, that even debt funds can throw nasty surprises, and it is not desirable to put a substantial part of your capital at risk by concentrating it in just 1 or 2 funds. So I think he can continue to remain invested in 4 short duration funds. But I like to point out that there are certain short duration funds which have a history of taking aggressive credit calls. By that, I mean that there are certain funds which have a history of investing substantially in bonds of lower credit quality. And that is something where he needs to be selective about and preferably avoid funds which take very aggressive credit calls. Other than that, for as a number of funds in his portfolio is fine.
Vinayak Kamath had invested in the regular plans of 4 funds 2 years back. Now he's planning to switch to direct plans. With the market at all-time high, is it the right time to do the switch, he wants to know?
I think he can go ahead with this switch, but as we've often said, the only things that he should be mindful of are the applicability of exit loads and capital gains taxes. So he should try and plan his switch in a way so that he's able to minimize any load incidents and any applicability of capital gains tax. In fact, we are right now coming towards the end of the financial year, so he may be able to benefit by splitting his switch between this financial year and the next one, because by doing that he will be able to benefit from the capital gains tax exemption threshold limit of rupees 1 lakh for 2 financial years. So yeah, broadly those are the kind of considerations that he should keep in mind, and depending upon the scale of his investment or the accumulated gains that he has in his portfolio, it might just be worthwhile to plan his switch in 2 or 3 blocks rather than doing it all at one go.
All right, now Virendra Kumar Gupta asks, are ESG funds good for 3 to 5 years investment? If one already has SIP running in 3 to 5 equity funds, would you advise investing in them?
So the first thing that I'd like to point out, as I was just mentioning a while back, is that I don't think 3 to 5 years is a sufficient time horizon to build an all equity portfolio. So he should consider investing only a part of his money in equities while the rest of the money should be in debt. That's one. Now coming to ESG as a theme for investing, well, ESG has been gaining a lot of prominence globally. In fact, a lot of global institutional investors consider ESG factors as a part of their investment research process and as a part of their investment selection process, and don't consider ESG as a separate standalone theme in itself. Now, the proponents or the advocates of ESG really build its case around 2, 3 key dimensions. One is that ESG is looked at as a contribution towards a bigger cause, because by investing in ESG compliant companies, investors look at it as their one of the ways in which they can give back to the society and the environment. The second thing is that the advocates of ESG also propose that given that a lot of global institutional investors have started looking favorably towards ESG compliant companies, so it is generally easier for ESG compliant companies to raise capital. Their cost of capital tends to be lower, and there are also less chances of a regulatory backlash. So all these factors contribute towards building a case for ESG compliant companies. And going forward, as there is greater realization and towards responsible investing, probably the tailwinds for ESG will only get stronger from here on. Now, the next issue is that whether ESG funds offer a unique investment proposition. Well, maybe not, because look at this graphic on your screen where we compared the few ESG funds that are available in India right now. So we compared their underlying portfolios with those of the mainstream multi-cap funds which the same fund houses have to offer. And what we found was that there is a fair degree of overlap between the stock holdings of ESG funds versus the mainstream multi-cap funds. So the broad point is that even by investing in the vanilla multi-cap funds, you are already getting a strong ESG flavor in your portfolios at the moment. So a more prudent way for now could be to wait and watch the ESG theme evolve more fully, and maybe then take a call on whether there is a strong investment case for a standalone ESG fund in your portfolio or not.
80 years old Arun Singhal, along with his wife, has a mutual fund corpus of about 2.5 crore rupees, and he says value research generally recommends investing a substantial sum in short-term debt funds. Why not balanced advantage funds instead?
Well, first of all, it depends upon the investment need. So if the need is to derive regular income from this corpus, then we suggest investing about a third of your money in equity and the balance in fixed income or debt fund products. And among the debt fund products, we prefer short duration funds for the core fixed income allocation, because we believe that these are the funds which possess those tenets that we seek from a core fixed income allocation. So that's why we prefer short duration funds. Now, coming to balance advantage funds and why we are wary of recommending them, that's because these funds manage their asset allocation between debt and equity in a dynamic way. So the fund management team has a complete flexibility to decide on the asset allocation and keep changing it depending upon the state of the markets or their outlook on the markets. And we believe that it's fairly difficult to take a call on the markets and move around your asset allocation with a high degree of success sustainably. On the contrary, we believe that it is better to decide upon your asset allocation depending upon your investing needs or your time horizon, and then manage it in a tight range around that predefined asset allocation rather than managing it more dynamically. So for instance, when I talk about regular income, and I said that we prefer an asset allocation where 1/3 is in equity and the remaining is in debt. Now, at times, balanced advantage funds could provide this kind of an asset allocation, but at other times, the equity allocation could be much more than this or much lesser than this. So it is about this predefined asset allocation or a relatively more defined asset allocation which we prefer to suggest, which balance advantage funds are not able to provide. And as I said, that a lot of these funds manage their asset allocation opportunistically, and we believe that it is not possible to sustainably get your call on the markets right. That's why we are wary of recommending balance advantage funds.
Now, Jayant Rathi has sent in the next query. He wants to know which type of funds, small cap, mid cap, or multi cap, are suitable to accumulate money for his grandson, who is about 2.5 years old as of now.
Well, I think he should certainly invest a bulk of his money into multi-cap funds, which are the most suited, or the flexi-cap funds as now they are called. And increasingly, a lot of multi-cap funds are getting reclassified into the flexi-cap funds category. So we believe that those are the most suitable funds to form the core of your fixed income allocation. But having said that, I presume his time horizon is fairly long, say 15 years or even more, given that he's looking to make these investments for his grandson, who's just 2.5 years old right now. So he can also consider having some allocation to mid and small cap funds, say about 20% allocation in total, which can be carved out for mid and small cap funds. These funds tend to deliver better returns over long term in comparison to multi-cap funds, but they are also riskier and much more volatile. So while it is not desirable to have a substantial portion of your money invested in them, but certainly with a limited dose, they can contribute meaningfully to enhance your overall equity returns. So I would suggest him to keep a bulk of his money into multi-cap funds, and then maybe add mid-cap and small-cap funds in a small dose to boost returns.
Okay, now Jyoti Sudas, to diversify internationally, should one invest in a flexi-cap fund with some international allocation or go for a separate international equity fund?
Well, there is no hard and fast rule around it. Certainly, international diversification is desirable. But I'd suggest that for a small investor who's looking to make investments of, say, about 5,000 or 10,000 rupees a month, it is desirable to keep it simple and maybe invest in a fund which invests a certain portion of its money in international markets. So a fund like a Parag Parikh FlexiCap fund can be a suitable one. But for someone who is looking to make much bigger investments every month, can consider carving out a separate allocation for international diversification and maybe add one international equity fund to his portfolio.
Gopalakrishna understands that one should park money which is idle for 2 to 6 months in ultra short duration funds, but should this be redeemed after 6 months irrespective of whether it is needed or not?
Well, I'd say that if at the time of investment itself, you know that you're not going to need this money for at least the next 1 year or more, then perhaps other categories of debt funds, for instance, short duration funds are more suitable for that kind of time horizon. But if you're looking to invest for about 6 months or so, then ultra short duration funds are suitable for this investment. And later on, if you feel that you don't need this money for a few more months, then there is really no compulsion for you to necessarily redeem after 6 months. You can continue to remain invested till the time you need that money.
All right, now today's last question has been sent in by Pawan Dev Law, and he says the performance of the dividend paying fund can be judged from its dividend over the years. But how does one assess the performance of a growth fund which does not pay dividend?
Well, first of all, I'd like to point out that dividend and growth, they are not two different types of funds. In fact, most of the mutual funds offer a growth plan and a dividend plan. So the underlying portfolio of these funds is similar, but just that the growth plan does not provide any intermittent dividend, and the growth and the returns accrue to you by way of appreciation in the NAV of the fund, and you get it all when you redeem your investment. While in case of the dividend plan, the fund may keep coming out with a dividend every now and then. So a part of your gains is redeemed and paid back to you by way of dividends. So that's one. Now, a fund which has a consistent track record of dividend, that does not necessarily uh, be a yardstick for its performance. So it is possible that a fund which has a consistent track record of paying dividend may actually be an underperformer in its category. So I'd say that be it a dividend plan or a growth plan, to be able to assess the performance of a fund, one should compare its long-term returns with that of its benchmark as well as its other peers in the category. So for instance, an investor should look at returns of the fund versus the benchmark and versus the category over longer time frames of say 3 years, 5 years, 7 years, or even more. And the idea is that one should not look at these returns only just at one point in time. So for instance, one should not only look at the 3 year, 5 year, or a 7 year returns currently, but one should also look at how these returns were last year or the one before. So what is technically known as rolling returns of these funds. So one should look at these kind of metrics to be able to assess how consistently has a fund delivered. And the other important thing is that you should not always chase the top performer. As long as a fund has delivered above average returns fairly consistently over long terms, that should be considered as good enough.
With that, it's a wrap on this episode of Helpline. Thank you, Ashutosh.
Thank you so much.
Thank you to all our viewers. You can go to VR Helpline on Value Research online and send us the questions that are stopping you from investing today. Our team will answer them in the upcoming Q&A session. Bye for now.